Welcome to another episode of Kiss My Assets.
The transparency, the openness, the communication is more than you could expect. I'm sold.
Don't let the fact that you don't know something or don't know enough about something hold you back.
I knew I wanted to invest. What better way to invest than to invest in what I already know that I love, which is real estate.
It was initially the 12% return, but it quickly turned into the people.
All right, well, welcome to another episode of Kiss My Assets. We have a lot of interesting things happening in the economy right now, so I wanted to get Bart on. Bart, thanks for joining us.
Yeah, of course. Thanks for having me.
And Bart is works in marketing at in Neighborhood Ventures, started a few months ago, so he's director of marketing, and also went to law school. So we'll see if some of that comes in handy today. So we want to talk about some of the things regarding the economy. The biggest thing initially that we're going to just touch on is some thoughts around what happened with Silicon Valley Bank. Just diving into that, we're now, a few days out of some of the craziness and the uncertainty over the weekend, where the Fed came in on Friday. The Feds came in, multiple agencies, FDIC, among others, and took over the bank. And that always happens on a Friday because they know that they'll have the weekend to sort things out before regular business hours and market hours open on Monday. So bank was taken over on Friday. I was busy online reading about what a lot of the people who are experts in the space were talking about, and it became really clear the federal government needed to come in and solidify the bank, not the bank investors or the bondholders, but the folks who had deposits at the bank.
Yep.
We know that the FDIC will insure up to $250,000 of deposits. A majority of the clients for Silicon Valley Bank had more than that because it's a lot of small businesses and startups. So I was glad that the government did its job. This is what living in the United States affords us, is we're able to come in, solidify the bank, let people know that all of their deposits were going to be whole. And this was announced on Sunday that anyone who had funds in the bank would have access to them on Monday. And that gave a lot of confidence to other banks who are smaller, more regional banks and depositors of those banks, because if there's what we call a contagion, where people get worried that their bank is going to have a run, even if the bank's in good shape, if there's a run on a bank and they have to liquidate assets before they want to give depositors their cash, that's not a good thing. So we were glad to see that the government came in, did their job, and solidified the situation. And then on Monday, we saw a lot of these regional banks really get hit hard when it comes to their equity value. Our local bank here, Western Alliance Bank, which is Phoenix-based, was down 50%. Its share price was down 50%, which is more since the Great Financial Crisis. On Tuesday, it's back up about another 10% as we're talking now. So I think that it seems like as we sit here now, a lot of the kind of chaos that was happening is settling, and that folks are able to see that the government will step in if they need to, if this happens to another bank. And we let our investors know that we have no exposure or relationship with Silicon Valley Bank. And just to kind of put their minds at ease, even though a few hours later, after we sent that notification out, the federal government came and solidified things. So, I think that the important thing for investors is you get a bit concerned that if you invest in a company like ours or invest in a project, how those funds are being used. And I think it's also in what bank they could potentially be locked in at. And given what the Fed has done, I think a lot of those concerns have gone away, certainly on our end with all the investors that we have and the conversations that we've been having. We had a few people ask questions, but those have really were really solidified with what the Fed government did. The other thing that's important about our business is we only hold cash for a short amount of time. So when we raise funds, let's say it's $2 million for a project, for a few weeks, we might hold those funds in a bank account, but then they are deployed to purchase an asset. So we don't hold millions of dollars in an account that's at risk. And that's the benefit of investing in real estate, is your money is tied in a fixed asset. And when things get weird, like they did at Silicon Valley Bank, it's nice to know that you're invested in a fixed asset, like a piece of real estate. And so our business is not like some of the businesses at Silicon Valley Bank who maybe raised a few $1 million from investors that would last them a year or two in paying their bills and payroll. Those were the concerns there that really put those businesses in a tough position. In our case, we deploy those funds very quickly into projects. So I think that's another important thing that investors should know. So besides Silicon Valley Bank, and before this happened, we have to now go back to kind of the fundamentals of the economy and some of the things that are happening. There was a great article that came out in the Wall Street Journal that I think pinpoints some of the key drivers of what's happening in our economy. And I want to dig into some of these things. And the title of the article is Why the Recession is Always 6 months Away. And that's what's happening right now, is folks are feeling like there must be a recession this year because of how aggressive the Fed has raised rates. And they're just kind of waiting for this to happen, but it hasn't happened yet. So one of the what this article says, just to start out, is, the government stimulus measures left households and businesses in unusually strong shape financially. And that's the backdrop of everything that's going on. This was happening, and at the same time, there's shortages of materials and workers. And so there's a mismatch between the cash that's available financially and the supply of materials and workers to deploy that. And that's what's really driven inflation. And what's happened now is that now many think that it will take longer to cool the economy, and that will lead the central bank to raise rates to higher than expected levels for longer. So the chief economist from Credit Suisse is saying that he calls this the Godot recession. Is that how you pronounce that?
I think so.
Godot recession.
Do you know why?
I don't know what that means. What does that mean?
I think it's a play. I don't know if it's Broadway, but it's a historic play, and they're waiting on Godot.
Yeah.
So they're constantly waiting on Godot, but he never comes.
That makes perfect sense.
So I had to Google that before. That's not a Bart fact. I didn't know that.
You could have just said you knew it, but
I knew it.
You're being honest. Yeah. So he's calling it the Godot
recession,
and that's like every 6 months, economists have predicted there'll be a recession in 6 months.
Yep.
And so he says, quote, by the middle of the year, people will still be expecting a recession in 6 months' time. And that's what has been happening. There's all this uncertainty about a recession coming, but it hasn't come because the labor market has been so strong. And we're going to talk a bit about that in a second. So just to go back a little bit, we know what the Fed is trying to do to slow the economy. They went from interest rates basically being zero, and then very quickly have now taken over the past 12 months rates up to 4.5%, and it's been in a rapid warp speed time. Typically, the Fed, when they raise interest rates, demand for housing and cars fall off, leading builders and automakers to cut production and lay off workers. But this time around, companies are still playing catch up, and so even though interest rates have gone from 0 to 4.5 in such a quick amount of time, it hasn't had the impact on consumer spending. Construction employment hasn't fallen, even though there's a big slump in new home sales.
Yeah.
And you would expect that as new home sales back off and construction on those homes back off, that construction employment would drop off, and it hasn't.
Yeah.
And so this is kind of this conundrum of what's going on. The Fed is being as aggressive as they can, but we're still not seeing some of the impact. And that's because folks have more cash available, and businesses are still kind of trying to get caught up on some of these things that have happened since COVID that have been in the works.
Yeah. So this reaction, like, it pertains to exactly what we're doing at Neighborhood Ventures, though. So we talked about off the podcast. Me and you have talked about when a pandemic happens, commercial buildings have failed, residential buildings have failed, but multifamily stayed strong. So, in the article, it talks about the commercial buildings or apartment buildings ramping up after the pandemic. So, I mean, for us, I mean, it's been great.
Right. Yeah. And people have been concerned that with interest rates increasing, that always has impacted the value of real estate because the cost to borrow increases. And that's always an element of buying real estate, is you can always get some debt on it.
Yeah.
And so when the cost to borrow increases, it has an impact on the value. But what we've seen here is that in our situation, the demand for housing in a place like Phoenix remains so strong that it isn't impacting housing like you would expect.
Yeah.
And our buildings are full. People continue to move here. And it hasn't, the big thing is houses have not decreased in value. We can see this, anecdotally in your own neighborhood. You would expect that going from, 3% interest rates to 6.5% or 7% interest rates, the values would really cater because that costs so much more to purchase a home.
Yeah.
And they've stayed pretty steady. The other part that's impacted this interesting environment is that U.S. consumers post the pandemic have ramped up their spending, and it's been tied to services that require a lot of workers, dining out, travel. That has been where a lot of those dollars have flowed. These sectors are often among the first to see demand fall when there's a recession, prompting job cuts. But we're not seeing that right now because consumers' spending has been rebounded, and even when we saw consumer spending ramp up again in January, somewhat due to lower gas prices and increases in Social Security benefits. Those went into effect in January, so we saw more spending power come back, and so that's the other part about the environment that we're in that's been interesting. So in January, employers added 517,000 jobs, and the expectation was about half that. So when people were guessing what they would expect it to come in at, it ended up being double what they thought. It was just so huge, and it took their unemployment rate down to 3.4%, which is a 53-year low.
So my question to that is why does steady job growth bring worry for more inflation?
Yeah, so that's a good question. The reality is that if the labor market continues to be strong and there's a demand for workers, supply and demand continues to drive up workers' salaries.
Yep.
And that is a good thing to a point, but it's not great if it gets to the place where it's driving inflation because more people are making more money, spending more money, and so the cost of living continues to move up.
Yeah.
So what the Fed is saying is, and there's a video. We'll take a look at this video now where Elizabeth Warren is talking to the Fed chair about this very thing, saying, why do we have to have higher unemployment to slow down the economy and stop inflation? Here's a little clip that you can take a look at.
We are taking the only measures we have to bring inflation down.
And putting 2 million people out of work is just part of the cost, and they just have to bear it.
Will working people be better off if we just walk away from our jobs and inflation remains 5-6%?
Let me ask you about what happens if you do this. Since the end of World War II, there have been 12 times in which the unemployment rate has increased by 1 percentage point within 1 year, exactly what you're aiming to do right now. How many of those times did the U.S. economy avoid falling into a recession?
You know, it's not as black and white as it very,
Just
very
looking
infrequent.
at the numbers. How many times did the economy fail to fall into a recession after doing that? Out of 12 times.
I think the number is 0.
I think the number is 0. That's exactly right.
So obviously Elizabeth Warren is a politician. And I'm just going to say, even if you agree with her or disagree with her, in this case, she is totally grandstanding, because it's clear that unless the economy slows down, which includes employment and wages, inflation's going to continue to be a problem. And even though that means some people lose a job right now, maybe a couple 100,000 people lose a job, that also means that 250 million Americans aren't seeing 7-8% inflation on their dollars. So she's grandstanding. She's trying to go for a soundbite, and Chairman Powell is basically, just looking at the facts, saying, "Yeah, we're not necessarily trying to get people unemployed, but we do need the labor market to slow down. And unless the labor market slows down, it's tough to bring inflation down." So that is one of the factors that's really continuing to push out the recession that we think is all going to be coming in the next 6 months. So business owners report confidence about their own prospects, but unease about the broader economic backdrop. So it's kind of interesting. Like, it's this idea that I feel like I'm fine, but as I look around, things don't seem to be great.
Yeah.
We are seeing there's some things that are kind of visible, especially in big metro areas. We're seeing increased people living on the streets. A lease is becoming more visible. A lot of the city governments aren't stopping that. In Phoenix, we have a lot of that happening in certain areas. It's not as prevalent as some like LA and some of those areas, but people feel right now, I'm okay, but I don't know if everyone else is okay.
Yeah. So, I mean, to dial it all back, the economy is just in a weird place right now. And that, it's because of Washington's reaction to COVID-19, obviously. Interest rates are up, but auto and home building are still thriving. And then we have consumerism post-pandemic, FOMO is what I'm thinking it is.
Yeah. And it was FOMO, and they also had more cash.
Yeah.
They're pretty cash rich. People were able to stop paying their student loans.
Yeah.
They were able to stop paying their mortgage. And so they ended up having more cash.
It's weird being three years removed in March. So March 2020 is when everything got shut down.
Right.
That's when Washington started to, not directly in March 2020, but we implemented the stimulus program. So now 3 years, we can actually get these reports and reflect on what's happening. I think a cool part of this article was talking about 1.7 trillion more in savings accumulated through mid-21 than if income and spending had grown in line with pre-pandemic economy.
Yeah.
That's crazy to me.
Yeah. And that money was out there, and that's directly tied to why we've had inflation.
Yeah.
Because that money wouldn't have existed in a normal economic environment.
Yep.
And then the last part of this is the nature of how quickly the Fed has tried to catch up with inflation. Initially, the Fed said, inflation is transitory. They thought it would come and go fairly quickly because it was more driven by supply chain, by some of these other factors. Even people like us who are in the economy buying products, buying renovation, construction materials, we saw that prices weren't transitory. They had just risen, and materials were harder to get. So we kind of saw that first, and we were skeptical about it being transitory, and it clearly wasn't. It was more driven by that money supply that you were talking about. So to make up for that, the Fed quickly went from 0 to 4%, 4.5%. In prior instances, the Fed would gradually do that. And this is the most that they've done since the 80s, all at one time. And one of the things that is mentioned in this article, so since October, the Fed has faced a challenge in which bond investors began to anticipate inflation would fall quickly without a serious downturn. As a result, they expected the Fed would cut rates sooner and faster than bank officials said they anticipated. So bond investors anticipated something different. They didn't expect that the Fed would be this committed to their plan. That risked an unhelpful feedback loop for the Fed. While the central bank controls short-term interest rates, long-term rates are influenced by broader market conditions, and they ticked lower between October and February, leading borrower costs to ease slightly. And then the 30-year mortgage came back down to 6% from 7% in the fall. The Fed kind of is playing this game of trying to tamp down expectations of what the economy is doing. Meanwhile, Wall Street has its own opinion and saying, well, the Fed is being overly cautious. They are they're trying to be hawkish when rubber meets the road. They will probably back off from this.
Yeah.
And we saw this actually with Silicon Valley Bank. So there's some that think Silicon Valley Bank is going to be the sacrificial lamb here to let the Fed start slowing down these increases in interest, because the Fed wants to be aggressive about taking interest rates up to slow down inflation unless there's a financial crisis. And we saw a mini financial crisis over the weekend.
Yep.
So they can do what they can, but we've seen that some outliers can happen, like what we had over the weekend. And now, as we're sitting here this week, 10-year rates have gone way down because the folks in that market expect that there could be some more, there could be less aggression from the Fed to raise rates because the economy is going to have some more falters. And that ends up being good again for car loans, home loans. And so that demand continues. So the Fed can only do so much until some of these outlying factors impact them.